I'm going to show you some charts that are going to blow your mind.
And I see a lot of scary charts in my day. This is one of the scariest ones I've ever seen.
Last I checked, gold prices were down $26 US dollars per ounce today so far. And there's two main reasons for the big decline in prices of gold. But you guys know what I'm going to say, so I'm just going to get to it right now. Just wait. Gold prices will be fine. And it was actually the late great Boone Pickens that said with oil prices, the cure for low oil prices is low oil prices. It's the same thing with gold, and gold could drop $200 an ounce today. It doesn't matter. You just have to wait. Gold will not go anywhere. Gold's going to be there under the surface grinding away, and it'll bounce around a little bit in price, but it's a trend that's going to go a lot higher. All the things that are going to drive gold prices higher are things like the deterioration of the US dollar, and I think that you probably have an opinion about where that's going. So you'll see my side of things anyways. But the two things that are driving prices down today is an expectation of rate hikes rather than rate cuts. Everyone's already factoring it in. They're expecting the Fed to pivot, rates to start coming down. And that won't happen yet. And now they're realizing that. So people kind of react to that. And that causes lower gold prices. People are less inclined. There's less money being driven into the gold space. And at the same time, there's hopes that we're going to reach a debt ceiling limit increase. And of course we will. If you look back over history from the dawn of time till now, they've never done anything other than eventually fight, hum and haw, and then raise the debt ceiling. They'll do it again. And they're going to act like raising the debt ceiling is a crisis averted, a problem solved. But really, they're not looking at the real problem in my mind. The real problem is the fiscal irresponsibility, the overspending, the creation of new money to cover up the deficits that we are racking up because we're not producing enough things that we're selling to other countries. All of that is the problem. The problem is not the debt ceiling. The debt ceiling is a made-up thing that we're all looking at going, I hope they fix this arbitrary allowance about how much debt we can take on. It's a bureaucratic thing. It's a contract. It's an agreement on a piece of paper. This is asinine. What you need to do is fix the economy, and then you won't have this problem anymore. We will always, always, always have debt ceiling problems. You'll see another one. I'm going to show you some charts that are going to blow your mind about all the times that we've had to raise the debt ceiling or raise the debt borrowing limit to avoid default. But before we get into this video too deeply, I'm going to say that this video is dedicated to Ziggy for your great comment that we saw on Twitter. Straightforward, honest, educated opinion, insight, and valuable tools to help navigate this economic train wreck we are facing. Well worth subscribing to Peter. Ziggy Wolf. Thank you, Ziggy. We love you. We love all you guys. For many of you, this is your first time here. My name is Peter Leeds, and along with my extraordinary team, we publish one of the most popular financial newsletters of all time. Nothing we say in this video is intended as personalized trading advice for you. And we've been in business for 25 years. You want to get our world famous stock picks, then check out the Peter Leeds newsletter. So here's one of the things that's driving prices of gold down is because the expectations changed from comments like this one. This is from Dallas Fed President Lori Logan. She says that the data points so far don't justify skipping a rate hike in June. June, they're going to possibly raise rates another quarter point. And the markets are starting to believe that, or they're expecting that rate hikes would pause or start coming down now. The Fed pivot would have begun. So gold prices do well based on that. And then when their expectations change because of the comments from, for example, Lori Logan, maybe we're going to be in for rate hikes at a higher elevated level for longer, and even another rate hike as opposed to no hikes at all or a decline in rates. The data in coming weeks could yet show that it is appropriate to skip a meeting. As of today, though, we aren't there yet, she said in a prepared remarks from a speech. Basically, they need to look at the data on an ongoing basis to decide what to do, which is what they've always said, and that's the way it's always been. Fed Governor Philip Jefferson also said inflation is too high. Well, thanks, Philip. And he's watching to see the impact that rate hikes will have on the economy before deciding on future moves. Yes, that's the job. That's what you do. That's exactly it. Of course, you wait and look at the data and then make your decision. It would be weird if he didn't look at the data to make the decision. But then he's got a quote talking about that's exactly what he's saying. But I have one thing I want to say about all of this, all the things that they tell you what we're going to do and what you expect to happen as an investor, as the Federal Reserve representatives, what they expect to happen and what they expect to do. The point is, all of this, the bets will be off. All bets will be off as soon as we get into what is coming, that you know is coming, is a recession. When we get into a recession, unemployment's skyrocketing. A lot of these businesses that are already struggling as it is right now, especially with increased interest rates, a lot of these businesses, individual people with debt, corporations with debt, we're all struggling under these higher interest rates. With the recession, that will change everything. Even though they're saying we're going to fight until we get to 2% inflation, all of those things will change in the recession where they'll be less hawkish, less aggressive. There'll be a lot of pressure politically to turn things around when we're all having a harder time in the economy.
Here's a chart from the Peter G. Peterson Foundation. Since 1959, to avoid a default under every different political party, how many times the debt ceiling was raised? How many times we've had to adjust the debt ceiling to avoid default? And I see a lot of scary charts in my day. This is one of the scariest ones I've ever seen. Do you notice a trend here? Do you notice a few times that they've had to give in to this asinine system of, oh, we have to raise the debt ceiling to avoid default and to pay the bills we owe, rather than making the economy stronger to pay the bills you owe? We're going to do it that way. They're just going to create new money. They're going to allow or authorize themselves to spend more money. And this is not a crisis being averted. This is a crisis that's never been fixed. It can only be fixed with fiscal responsibility and economic health and growth, none of which that we have.